Welcome to our results for the 6 months to 31 January. I wanted to start with obviously the thing that's affecting everyone globally, which is COVID-19, of course. So operationally, the business has been very robust, as you might expect from a software tech co. So there's been no disruption at all to customer service levels throughout the whole event. We managed to take our team from 100% office-based to 100% home working-based within a week. The teams are working all well, they're connected and really engaged in their work. And we're set up to continue at this level for an indefinite future. So operationally, all very solid and sound. The SaaS business model, again, is robust and resilient, particularly in the short term. We're monitoring it closely. We meet weekly as an ELT to look at that. We do have some short-term revenue risk, which we feel is offset with natural savings, particularly in our you would naturally expect new business to slow down. That has happened marginally, we would say, in the short term. But again, on the other side, churn is markedly better. And therefore, we feel that on balance, revenues are safe. We're not immune, though. Where we have risk is in customers with variable or volume-based contracts. We have some risk where customers are unable to undertake a deployment or an implementation because of their own limitations, and we find that implementation services may be at risk marginally in the short term. And then our business on tenders direct, which is a supplier paid product. This is essentially a product that is competing for marketing budget, where we filter leads generated from OJU for against customer parameters and present them with new business opportunities. And those customers are tending to defer decisions. So again, no issue in the short term, but in the medium term could become an issue. So we have the three areas where we're at higher risk. But then in the short term, we're certainly balancing those with natural cost savings, with marketing events being pushed out because they're not available to have. Our T&E is significant spend across the group on an annual basis, and that's stopped. And of course, we're deferring recruitment plans until the picture becomes clearer. So natural savings against any short-term revenue risk, we think, and therefore the summation of that is that we are maintaining our forecasts for FY20 certainly, and then evaluating what might happen in the longer term if COVID-19 persists. So FY21 could be more substantial, but then we have again some contingency cost plans in place ready to react to that quickly. So we feel that we are well positioned for COVID-19 in the short term and into the longer term if it takes us there. So moving on to the main highlights and key messages for the period. Well, we feel that we have made some more than encouraging progress in the deployment of the strategy that we set out last April, and we are still remain convinced of the significant opportunity to accelerate this performance into the midterm. Ultimately, we are selling more new business now than we are losing through churn, and of course that's a trajectory change from what we've experienced in the last 2 financial years. So at present, at this time, cumulatively, at the end of April, we are organic growth in net ARR. So we have turned the ship at this stage, although it is still cautionary to note, it is still quite early in that process, but the indicators are good. We've also taken bePayd live, so it is used now by Proactis against its supplier base, and seems to be being received quite well. It wasn't a financial story, it was more a operational story, a referenceability pitch, you would say. But pipeline is growing. It's obviously very relevant in the current environment. A major step forward that we've made is to reset and improve the banking facility. So the group is now fully funded to go about its business. The gearing remains obviously relatively high, but that shouldn't have any kind of implication on the facility. We feel we've removed any kind of concern that an investor should have about facilities and governance and all of that kind of business. And of course, as I said, we're responding pretty well to COVID. So let's move on to now the highlights of the performance. I'll talk about the 6 months initially, and then build in the post-period end trajectory as well. So the financial results themselves in terms of income statement are really reflective of the prior year performance on new business and churn, which was poor. We had a 5 million net negative ARR in the in the previous financial year. So revenues have dipped to 24.5 and EBITDA to 5.6 million, which was in line with where we thought it would be, but obviously dip is never good. But all of the other indicators in terms of forward trajectory are now good. So we had net growth in ARR in our core of about 4%. That's 7% annualized. That's as good as PROACTIS historically has ever been in the core business. But net ARR growth was held back then by what we call our high-risk accounts, where it was flat, including those high-risk accounts. New business accelerated itself in terms of the volume of it, 44% up against the previous 6 months, 23% against the 6 months before that, to 7.5 million, with a healthy number of new names and upsells. Customer churn halved, which was excellent performance against the previous 2 years. It was normalised in the core business and better than we thought in the high-risk accounts, and there's some more data on that in the next few slides. And bank debt reduced by about £1 million to 35.6, so still profitable, still cash generative, and now starting to grow. Post-period end, we've moved along further. Obviously, the FSP terminated. The net growth in ARR in the core, and now including HRA. So we've moved forward even further in the third quarter to be ARR positive across the whole group, and continuing obviously to accelerate in the core. Our cumulative TCV is up to all intents and purposes equivalent to the whole year last year. So excellent performance in that, but only the drop, the tip of the iceberg in terms of how we feel about the opportunity. Customer churn has improved further, and latterly in April was virtually nil, which probably was largely COVID-19 driven. bePayd is now deployed, as I said, against PROACTIS' UK supplier base, and we've reset the bank facility and now fully funded for the midterm. So lots of work being done in the previous 12 to 15 months in order to get ourselves to this position. The position is good, but it is still early, and we do have that cautionary note that we're keeping our feet on the ground. So I'll hand over to Rich now to take you through the detail of the financials.
Thanks, Tim. Good morning, everyone. So taking you through the financial highlight slide, first of all. As Tim just referenced, revenue for the period was £24.5 million compared to £27.7 million in half one FY19. The reduction being due to the customer losses in the prior year that again, Tim just referenced. Moving to adjusted EBITDA, which was £5.6 million for the period, compared to £8 million in the prior year. The revenue impact just referenced was slightly offset by an element of lower costs in the half. Basic loss per share, which we don't show on this slide, was 1.9 pence per share versus a slight earnings per share of 0.1 pence in the comparative period. And adjusted earnings per share, as you can see here, was 1.1 pence per share based on management's adjusted profit position. Total TCV won, as Tim just referenced, for the period was £7.5 million, representing a 44% increase on the prior half and a 23% increase half one versus half one. This total includes 29 new customer name deals in the period with a TCV of £5.4 million. This compares to 34 new name deals in half one FY19 with a TCV of £4 million. The new name wins were spread around all territories and shows how our growth strategy is starting to take hold. Upsell and cross-sell deals were stable versus the comparative period at £2.1 million, with the majority of this, £1.4 million, coming from the UK business unit, with no single deal in that period bigger than 190,000 for that territory. Annual recurring revenue, or ARR, is obviously one of the key metrics for the business, which Tim will go through further in a few slides' time. As an overview, and as discussed as part of our year-end presentation last time, we ring-fence certain specific customers into a heightened risk accounts, or HRA bracket. This totaled £5 million across the group, and is based on the perceived level of risk of customer loss across our buyer business. At the end of the period, ARR, excluding those HRAs, was £40.7 million, compared to £39.3 million at July 2019, so a 3.6 or rounded to 4% increase in the period. Of the £40.7 million, £32.9 million was attributable to buyer subscriptions and £7.8 million to our supplier paid products. Including those HRAs, Annual recurring revenue at the end of January was £43.4 million, compared to £44.3 million at the end of July 2019. And finally, on this slide, net debt at 31st of January was £35.6 million, compared to £36.5 at the prior year end, so a reduction in the half of £0.9 million. This slide shows the adjustment in the top part from reported operating loss or profit to an adjusted level, taking into account non-core expenditure, which is down versus the comparative period, and in the current period principally due to restructuring costs. We also show intangible amortization and share-based payment charges, the latter two being broadly consistent half one to half one. The bottom element of the slide also shows cash payment adjustments of non-core expenditure to get from reported net free cash flow to an adjusted level. So we show on this slide how the low level of impact that net churn of the £0.3 million that you can see at the bottom of the slide has had on the revenue impact during the period. Annual recurring revenue represented 91% of total revenue in the period, with the remaining contribution from services and licenses. Handing back to Tim now for the rest of the slides.
Thanks, Rich. So how are we doing against our growth strategy? Well, encouraging progress. So this is obviously a pictogram of what we're trying to achieve here at PROACTIS against some timelines and and a status report. Ultimately, the left two chevrons are really about our buyer business. And this is around maximizing our opportunity within that business. And we feel that the opportunity size is really, really significant. So the first chevron is about managing customers better with a objective of at least equalizing churn with upsell, cross-sell in our business. And we're pretty well on track with being able to do that. It's something that we regularly achieve and beat, in fact, in some territories. And we want to equalize that through all territories. And then, of course, accelerating new business. That puts us on the first chevron puts us on a fantastic foundation for growth. And then new business adding is really super. So we are, as I say, scratching the surface here at the minute. We do well in the Netherlands, do well in the UK. Although the UK in the 6 months has been a bit slow on new business, made it up in February and March. But we are not getting the equivalent level of contribution on new business yet in France, Germany, and the US. And we wouldn't expect to have that at this stage. They've been through huge transformations, but we are expecting them to build to that over the next couple of 3 years. And if they achieve a level of performance that is equivalent to the UK, or the Netherlands proportionately, with some limit in the US, of course, because it's a huge market, then we will be delivering 10 million of net ARR per year or thereabouts. So that's the size and scale of the opportunity that we have to go and access here, which is incredibly exciting for us to go and try for. The next areas are related to supplier paid solutions and supplier paid products. There's the third chevron is the existing products, and we brought out bePayd as the fourth chevron because it is individually a hugely significant opportunity. So we've been doing enormous amounts of work in the last 12 to 15 months in order to be at this stage. But we always felt that these would be key themes in terms of visibility of traction or trajectory in FY21. So we're ready for that. We've done lots of planning, lots of execution in order to build to this stage. But we should start to see improvements and movements on both of those areas in FY21. And then finally, of course, this is a longer term opportunity, and that's to extend the supplier paid product portfolio and indeed to add additional modules into the buyer solutions over time. So we do want to put one new module or supplier paid product into the portfolio per year. Now that's a longer term opportunity. So we're at the early stages of planning right now for that, but hopeful to start launching that and hopeful to start seeing that happen into FY22. So we've got a nice blend of current activity, fixing the stuff that needed to be fixed in our core of our business, the 80 or 90% of our revenues, then starting to add in and develop the smaller part of our business on the supplier side, and then adding into the portfolio in the longer term. So a nice balanced strategy that we're thereabouts on schedule with throughout the whole piece. look into a bit more detail into the first two chevrons now, which is crucial about the ARR and churn. So the first slide I want to take you through is ARR. The second slide over the next page would be churn. You can see that the UK is flat ultimately. It's caught up in February and March, of course, but so it had a slow first half, and it had that's as a result of having a weaker pipeline coming into this year. So we'd used all the pipeline. We created our own problems on pipeline way back 18 months ago, and this is the fruition of that. In the last 6 to 12 months, we've built pipeline back up, and they're starting to see the UK turn back to normal. But you can see the transition then in the other elements of the group in the Netherlands, US, and France and Germany. Incidentally, going forward, we'll be bringing France and Germany separately because they're both now managed independently by the commercial teams that are set up in those territories. But really very, very good progress. Those are healthy levels of growth, 7 and 5 and 9 for the half year. Annualized growth is really strong, actually. So, and only touching the surface, as I said earlier. And we can see, I'd say, net growth in buyer ARR, a little bit of a reduction in supplier ARR, principally in the transactions business. And that's a result of some volume reductions as a result of the buyer business that left us 6 months ago. There's always a lag between the transactions business on the supplier side against the buyer business. But as I say, that's a key theme for FY21. The take home here is that in the problematic areas, we've seen some really good progress, and we expect to see a return to normal business or business as usual in the UK in the second half and beyond. So down into customer retention, which is the core of everything in reality. UK improving. It had a one-off in half two last year, which was an inherited non-spend management customer. Effectively, we took over the management of Brakes Brothers. It was actually, we might as well talk openly. And 1.3 million was with Brakes Brothers, which was an inherited Perfect Commerce customer, and that business was ultimately lost, but left referenceable. So the underlying position was 0.6 in half 1 19, 0.5 in half 2 19, and then 0.4 in the first half of this year, which is around about normal. And then as good as or better in most other territories for churn. I want to bring out 3 renewals, specifically 2 in France actually, and 1 in the US, which together represents about 2.1 million of ARR. All of those 3 customers have renewed in the last couple of months. ING actually just yesterday, and all with cash upfront payments. ING was a 4-year deal, actually, about 3 million euros in total. So some really substantial renewals of some relatively risky customers. And actually, across the 2.1 million, that represents a 10% upsell of ARR across the 3. So very excited about what we've been able to achieve through better engagement with our customers, specifically in these 3 cases, but generally, as you can see, with the improving churn position. Nil churn at all in the Netherlands. And that's, of course, a model that we would love to get to. And COVID-19 is reducing it even further. And in fact, in the whole of April, there was, I think, about £20,000 of ARR of loss in that particular month, which is virtually nil. A little bit now about bePayd, which I want to bring out specifically. So what is it? Well, that's just a quick reminder. So it's a financial platform to help suppliers get paid earlier and quicker than their existing terms with their customers. It settles the approved invoice early in exchange for a discount, which is normally paid by the suppliers, but the model can be flexible. The target market is unique in that it is targeted specifically at the micro nano cap suppliers in a buyer's supply chain, sometimes called the tail spend or the tail spend area. And therefore it makes it complementary to most of our peers in the this broad umbrella that we call accelerated payments. And there's limited risk. The risk is structured around the buyer's balance sheet, not the supplier's balance sheet. So the risks are mainly around buyer solvency, which is heightened right now, of course, in COVID, or late payment by the buyer, which would be a margin risk for us rather than a payment risk. The progress has been really good. So we are live at minimum viable product. Normally, when we say minimum viable product, we think it's sort of some kind of strings and sellotape thing, which is not quite good enough. This is not the case here. So it is market leading in this sense, and certainly in around speed. where supplier onboarding is less than 3 minutes, and you can get access to a payment and get it paid in less than 30 seconds, which is an incredible site. It's visible in bePayd website. You can see that process and how that works. You can experience it live as if you were on your iPhone, taking that acceleration. There's a model of that. And normally, of course, when you talk about speed, you give something up, and it's generally around security, but this is not the case here. We're a bank grade security product, so very highly secure, as you would expect. So how are we doing? Well, it's all about commercialization now. The offer is incredibly relevant in the current environment, but it was anyway. We're assessing how we might apply it with the Scottish and Westminster governments in this particular environment. But of course, adoption of innovative technology that isn't referenceable in slower or uncertain environments is incredibly difficult. So it would be cautionary, but we are very excited about this product. So onto our summary and outlook. Encouraging progress. I think we have to say that it's early days. We're cautionary still, but significant midterm opportunity, as I described earlier. Massive improvements, in fact, in new business performance and customer retention, which creates the platform as ever. We've got to have a growing ARR, and that's a step change in our performance. So we're incredibly happy about that. bePayd Live pipeline is growing and relevant to today. Group is fully funded, so we've taken away our Achilles heel in terms of banking, and we're responding well to our coronavirus challenges. So our outlook is pretty positive, even in today's world. So we must remember we're a profitable, cash generative, SaaS-based software company selling B2B rather than into consumer-led spaces, with a growing ARR in an exciting growth market. These are good fundamentals. COVID risks are monitored closely and covered and resilient to it, maintaining guidance in the very short term, next 3 months, would you believe it? We've reset our banking facilities. It's an essential foundation to the strategy and the financial strategy specifically. We're really well positioned in terms of our teams. They're set up to deliver next year's volumes, so we're well structured in that sense. And the bePayd pipeline is growing and very relevant. So even in a difficult time, we've got a lot to be cheerful about, but a huge amount of work to do to realise it. So I think that's the end of the press. So I think we'll open up for questions now.
We have a question from Edward Mansfield, who asks, with the increased focus on retention, is the HRA pool now declining in size going forward? Well, we obviously the HRA pool is a 5 million ring-fenced customer group where we felt that on balance we had a higher risk of loss than retention. And we did that, of course, to help ourselves engage with those customers in a different way and get ourselves more focused and targeted. There are a few routes out of that group of customers. Number one, you could sign a longer-term deal, a 3 or 4 year deal that automatically makes you into a normalized customer, of course, and therefore you would come out of the HRA pool in that respect. We could lose the customer, of course, and that's the other end of the extreme. And then there's the bits in the middle where we would look to secure additional revenue through alternate or mitigated product strategies where we're adding in a different point solution to help. So lots of different aspects to it. But yeah, I mean, ultimately, it'll get to a level where it becomes normal. We're not far off that right now, if you think about it, because we've got probably 3.8 million left of the 5, having lost 1.2 so far. That's less than 10% of our ARR, which is not indifferent, I wouldn't suspect, to any other company's customer portfolio in terms of risk profile. What they do tend to be is larger. And therefore it's not as well hedged as the rest of our customer base, where we might average 30 to 50,000 of subscription a year. These could be in the hundreds of thousands generally. So it tends to have a bigger impact, and we felt it was just right to manage those accounts separately. Now I will move on to Andrew Bryant's question from Liberum. Roughly how much of your ARR is based on variable or volume contracts? You added 29 new name deals. You've talked over the last year about clients you are now not targeting, but specifically, have you changed the clients you are now targeting in terms of size or sector, or is it simply the geographic opportunity in France, Germany, and the US? I'll leave it with those two and come back with the third afterwards.
So the volume-based contracts is small, Andy. So I would say it's less than £1 million of risk across the whole piece in volume-based contracts. It goes across a few different areas, but around about that kind of number. And of course, it's not a question of customers doing nil volume or 100% volume. There's a whole range in between there. So that's the kind of exposure that we face there. In terms of targeting, we do obviously have customers that are outside of our I hate this phrase, sweet spot. The sweet spot is huge. It's between 50 million of operating budget and 2.5 billion of operating budget, and we're looking at that kind of customer, that kind of size and scale of customer in every single territory now. But of course, we have some customers that are outside those boundaries that we will fight like hell to retain and keep and serve well, and we do serve them well. Generally, as can now be seen in our churn rates. So the go-to-market strategy is set. It's clear. It's consistent in all territories. There are some niche areas around public sector where we're sort of predominantly in the UK, a little bit in the US, and not much in the other spaces, in the other territories. But generally, it's that mid-market, mid-sized organisation. And I use the size only as an indicator. It's more really about how the customer behaves in terms of their go-to-market or their buying process, whether they manage their projects themselves or through a consultant. That's quite a differentiator, which helps us if a direct manager, if they manage their own projects, is an important one. So it's about behaviour rather than necessarily size, but size is the best indicator here, and it's consistent everywhere.
And the last question from Andrew Bryant is: during COVID-19, have you seen anything interesting in terms of buyer or seller behaviour?
So it's difficult to assess a few things. It's difficult to assess whether the slowdown that we've experienced, I mean, we have signed less new business in April than we did in March and February, but not so much so. But our assessment is that new business is slowing down, but as I said, balanced against churn, which has virtually disappeared in April. So there is that kind of behaviour. Not sure whether it's operational difficulty in people making buying decisions, as in they can't get together to make a decision, or whether it's human nature, which is I'm uncertain, so I'm not going to choose, or whether it's economic and therefore a sort of slightly more challenging issue. That is yet to play out, and we'll see how that goes in the next weeks and months. But certainly a slowdown in new business and a market improvement in churn. So that would be the first thing that we've observed. And then the other things that we've observed is it creates opportunity. Obviously, we see that opportunity in bePayd on the supplier side and on the buyer side there. But also we see other competitors where they've been unable to continue their service to their customers in their invoice capture area. And we can, our software, our capability is able to fulfill that solution or fulfill that need through these times. And then we see decisions where in the high risk accounts, as an example, where we were fairly sure that a customer in the States would be transitioning off our platform onto a different competitor's platform. That process is now derailed, and the view is that maybe they can't quite afford to go to that provider and might want to stick with PROACTIS platform. So it provides opportunity as well as difficulty. You might also talk about, I mean, we do still have some customers that are on premise, from the old Proactis days, pre Perfect Commerce and way back pre SaaS days. We might see opportunity there because security is even more so now, better in the cloud. So it creates opportunities, and therefore we start to transition our marketing, not least on the messaging, but also in how we do it. So much more digitally influenced, although we were always digitally influenced as well. It becomes more concentrated in that area. So lots of opportunity as well as challenges.
And next we go to Harry Evans from N+1 Singer.
Thanks very much. Thanks for taking the question. Just a couple of questions, if that's okay. One on growth. You seem to be adding about 2 million of ARR, gross ARR. I'm just talking about sort of unadjusted, if we include the HRAs, about 2 million of ARR on a per annum basis. Is there anything that you have to do differently to sort of, as you look to sort of step that up, maybe to 3 and 4 million pounds of ARR or whatever your goals are going forward? Yes, just is there anything that you need to do it differently, or is it a continuation of what you're doing already?
Okay, Harry. So Rich will correct me, but I don't think your number is quite right there. So I think we added in the first half 1.8 million gross of ARR.
That's correct, Tim, yeah.
Yeah. So we're sort of 3.5 to 4 on an annualized basis if we maintain this level of business. So that's attractive, particularly if we can get to a position where our existing customers, any losses are matched with upsell, cross-sell, of course. So we can get to an attractive position there. But it is the tipping of it is the tip of the iceberg, as I tried to describe on the strategy slide, because at that level, what we're not seeing is France, Germany, and the US as economies, in terms of economy size. We're not seeing them contribute at the same level as we would expect to see and do see in the Netherlands and in the UK. And so there is the opportunity to create an equivalent sized team, capacity, capability-wise, in each of France, Germany, and the US to access the market opportunity in those territories to an equivalent level that we do access generally in the UK and specifically in the Netherlands. So the only challenge that we have from here is pipeline build in terms of marketing size and capacity, and then in sales execution, in size and capacity. So what we'd expect to see, and this is rather why, if we're looking out into FY21, we don't see a significant margin improvement at an EBITDA level. And that's because we're planning on, as we build pipeline, as we build execution in sales, that we put more into those areas in order to achieve real leverage in the following year. So it's all about replication now. Replication, first of all, of the models that we have in the UK and the Netherlands, which are equivalent in each of France, Germany, and the US. We've done that in a small way in France, Germany, and the US right now. And it's a question of then within those teams replicating and building out to a size and capacity that's equivalent to the UK team. And if we do that over the next 2 to 3 years, we will be hitting that 10 million net ARR per year. So it's a maths game. It's not, of course, it's very difficult to do because you need real high quality people. But in terms of, it's simple in terms of its explanation now.
Okay, that helps. So it's more of a sales rather than a product piece.
Yeah. The product is absolutely ready. It's internationalizable and it's relevant to customers, whether they're French, German, American, or Dutch.
Okay, thanks. And just one follow up on churn. I see that's been coming down. Is that sort of Perfect Commerce sort of concentrated, and just how you? I know you've already touched on it, but sort of how you the sort of major learnings that you've had in sort of reducing that, and how you see it going forward.
So yes, it is. And if you looked at the table, it's concentrated in France, Germany, and the US, where the difficulties have been, or one customer. I mentioned Breaks Brothers, one customer that was a Perfect Commerce customer and came into the UK team. But essentially, it's been around that area. But I hasten to add, it's not a generic issue across all customers. It's a specific issue on a particular product set, which is an SAP equivalent to our spend management system, of which we have a product that we put on the side of it, and it's that product, that third-party product, is not going to be supported after 2025, and therefore the customers are going to go one way or another. Historically, and in the last 2 years, they've all gone to an SAP equivalent. But what we're seeing now is that where we've been able to engage with that customer and provide an alternate solution, which is an authored product, through being more coordinated internally, what we're finding is that there's a chance that they won't move from our particular solution into an SAP equivalent, or moving from their existing solution onto the SAP equivalent. So it's about engagement, customer engagement, and hitting the particular problem. The customers that we've lost, by the way, have been with us for 10, 15 years and have been very happy with the service and the solutions that they've had. The issue has been the driving point about the backstop date on the SAP solution not being supported. And of course, customers of this size and scale can't have unsupported software. So there's been specific issues that have come to fruition, and now we're handling them better and mitigating them a lot better, but they are still there. I hope that helps. It's a complex issue, but it's not a generic, France, Germany, America are rubbish, and they can't handle their customers properly. They could do it. They have done a lot to improve that over the last 12 months. Of course they have, and they're better engaged, and they're quite not so defeatist, because we're giving them alternate products that they can sell into those customers and have interesting conversations rather than difficult conversations. So the energy's changed, the appetite's changed, the inputs changed, the product portfolio that they can take to their customers has changed, but the customers remain at risk until they go one way or the other.
That's very helpful. Thank you.
And now we'll move over to Martin O'Sullivan from SureCap. Martin, your mic is now open.
Yes, thanks very much. Yes, thanks for taking my questions too, if I may. The first would be on upsells. In the UK, you had 49 upsell deals versus 48 last year. So almost the same number, but the TCV of those deals increased by 27%. So I was wondering if you could give us a sense for what's sitting behind that increase in TCV.
We have a thanks, Martin. We have a huge portfolio of solutions, and the mix and match of those between in our cross-sell, upsell, as well as our new business can shift. I would say we were fairly light last year in terms of what we were upselling, and so we have a particular part of the suite which is called our P2P suite, which is generally an entry product, but can be a cross-sell upsell if a customer takes a sourcing product to start with. What we've been able to do in this year is sell a P2P deal into a cross-sell, which is an excellent thing to do. And it's repeatable. Of course, it is repeatable, but we would say that the performance has been good in the UK on cross-sell share, and it's covered essentially a relatively poor first half in terms of new business. So across the blend, it's fine, and that's the great thing about having the portfolio of over 800 customers, all with elements of the suite, but few that have all of the suite, that you can cover phases of performance with in the different areas. And that's what we're trying to do across the rest of the group in reality, because historically we've been targeted at much larger deals, let's say in France, Germany, and the United States, much larger deals, and that risks your pipeline, it risks your decisions, and it risks your income statement once they come into the income statement. Of course, we're trying to steer away from that, and we're seeing that in the UK in the first 6 months, where we've been relatively successful in cross-sell, upsell, because of the portfolio of the deals that have gone in this particular 6-month period, all of which are repeatable in principle. It's fired well, but not on all cylinders, and it's covered where it hasn't fired well on the new business side. So it's natural movements in products sold in, or between new biz and cross-sell. So hopefully that answers it. Not a specific. It's not as I think Rich gave a stat on it earlier. There isn't one of those deals that was over 200,000. So again, a really nice add-on, really nice rate of a blend and a spread of risk across it. So really, that's exactly our model.
Okay, thanks. That's clear. And secondly, with regards to accelerating new business in the medium term, I was wondering if you could give us a sense for what you think will be sitting behind that. Is it market growth, strategic execution, M&A, for example? In other words, what are the drivers behind your confidence in the medium-term outlook?
Yeah, so it's definitely not M&A. We have no need at all, no appetite at this present stage. There is enough, inside of us to be very exciting without M&A. The market is still consolidating, I should say that, and historically, with one massive exception, we've been exceptionally good at our M&A execution. But it's not about M&A; it's about organic growth within the business, replication of business process in France, Germany, and the US compared to the UK. So I would say it's a return to normal business in the UK, a continuation of normal business in the Netherlands, and a replication of those two processes, practices, skills in each of France, Germany, in the US. And it's about marketing and awareness. It's about customer referenceability and early traction, and then the building out of the sales teams to execute. So all within our power. We would say that the French, German, and US markets in the segment that we target is behind the UK. The UK is a leader in this mid-sized segment internationally. We feel that all of France, Germany, and the US will logically follow. CFOs, who is our main buyer within a customer, behave the same in those territories. They have the same pain points, the same needs, and we feel that we can fulfill those with the software that we already have. So there's little to do in terms of product. There's little to do in terms of market development. The market is there. It's about execution, good execution of marketing and sales from here.
Okay, thanks very much, Tim, and well done on the results.
And next we'll go to Andy Darley from FinCap.
Thank you. Morning, chaps. Just looking at your TCV for the period to January, notably it's a record level of new TCV for the group's history, but within that, the 5.4 of new name deals is also at a record level. What are you able to give us some guidance on exactly what services and implementation revenue will be associated with putting in TCV of that scale and over what period?
Yeah, so one of our USPs to our customers is that services is a very small part of our business. So we would expect to do about 5 million per year against within the 50 million of total revenue, which is services, and as the construct of a standard contract, if there is such a thing. The construct of a standard contract is that we offer a 5-year contract at 50,000 a year of a subscription, and we charge 50,000 of implementation fees. So one of our USPs, which is why we are very strong in this more budgetary constrained segment, is that the fast access to benefits and low cost of implementation with low consultancy projects is a massive benefit to these customers. So it's a very small part of it. It's very fast. So you would expect a sales cycle to last anywhere between 6 and 18 months. Sometimes they'll go a bit longer, but 6 to 18 months. And once deployment, we want to get you up and running in 100 calendar days. And 50 grand is about 50 FTE days on our side. So really fast access, relatively short time frames. Depending upon customers' own project timescales, it's very rare that they buy in advance of a project 12 months out or whatever. So fairly fast access.
And is there any constraint in the current environment of being able to undertake that implementation?
Some, but all at the customer level. In fact, our deployment has been very strong in pockets around the place, particularly in the Netherlands, actually. And they are actually going to change their process of deployment to be as it has been through this crisis. So it's improved the directness of the process. It's improved the efficiency of the deployment. And of course, the product is all in the cloud and capable of being handled remotely. So there's some good things that have come out of this process, but some customers have had to defer because they're not operationally capable to fulfill it. But those values are quite low, quite small. They're a handful rather than it being the majority.
Great, thank you.
And we have Andy Bryant again from Liberum. Do you think any of your competitors will have challenges in this environment in terms of needing to raise equity or bank debt?
Our competitors fall into two categories. There's the big global guys that are all massively funded, but we rarely see them. We certainly don't see them in our bids on every bid. We might see one of them in each bid, but it's not like we're lining up against Cooper, iValue, Jagger, Basware, and SAP Ariba on every single lead. Where we tend to win is, we beat them regularly and we lose to them regularly, depending upon what the customer's buying strategy is. We also compete against local national players who are on tighter budgets, generally smaller, don't have international capacity or capability, and we might see some of those guys struggle a little bit further than they perhaps have in recent times because they're just much inherently more fragile. But our business model is very similar to many other competitors' business models, and therefore we should expect them to be as resilient as ever and as resilient as ourselves. So I don't expect competition to fall away particularly, but here's hoping.
That is actually the end of the questions. So Tim and Richard, many thanks indeed.
Well, thanks for taking time, everyone.
Thank you.
Pleasure as ever.